Yes, so the first thing to say is we've had very coordinated rate cuts across developed markets and across developing markets, and the fact that central banks have been so proactive has lowered the chance of recession in 2020, and as a result we quite like the environment for credit at the moment. The next thing to note though is returns from bonds are going to be likely a lot lower going forward than they have been in 2019, but we still think the prospects for alpha are good, particularly because there's going to be more dispersion, more volatility, and there's an increasing number of negatively yielding securities as well. And lastly, we think this is a good environment for emerging markets, particularly with the Fed cutting rates now. We feel the prospects for the dollar are more mixed. We feel valuations in emerging markets are attractive, and this offsets some of the trade wars and geopolitical risks in the sector. Well, we would have a preference towards corporate bonds at the moment. We think valuations are reasonable and off their tights, so the preference would be to corporate debt. We don't, however, expect a big rally in spreads. Where we see opportunities is in security selection more than taking directional views on corporate credit. Government bonds do look very stretched here. There is a large expectation in the market for future rate cuts next year across a variety of markets, so it's going to be hard for central banks to do anything in excess of what the markets are expecting. Having said that, we don't expect negative returns from government bonds, just a lot lower returns. Absolutely. Well, we've had a good year of performance, both in absolute terms as well as in alpha returns over the benchmark. It's come from a variety of sources. We have been long duration. We've been long duration in a dollar block, and dollar block bonds have outperformed Europe and Japan, particularly places like Australia, where we've been long. We've also had a curve flattening bias, particularly in Europe, and that's been beneficial. We've had a long carry position across a number of sectors, including BBB industrials, high yield, and emerging markets. And our country and security selection has also been strong, particularly in periphery Europe, where we've been long Italy, Portugal and Greece. In terms of managing risk, we believe very strongly in the fund that no one factor should dominate risk. We very much believe in diversification, so we don't want all of our risk to be dominated by a dollar view or a country view. We believe very much in taking risk in multiple areas with a bias towards security selection and asset allocation.